Alright, good morning then everyone as we head into European trade on Friday the 13th of October. It's Friday the 13th. Be careful out there, folks, in financial markets. Not the best day for trading. Historically, I think that's more of a psychological thing, but anyways, we'll see how today goes. Stocks in Asia slump on rate yet. As you can see, Asian shares slid on Friday and were on course for the steepest one-day percentage decline in a week after stronger than expected US consumer prices figures bolstered the case for the Federal Reserve to keep rates higher for longer. I think it was slightly overcooked that CPI move from yesterday, but again, I'll have a look at it as and when we get to it. Oil prices up on Friday after the US tightened its sanctions program against Russian crude exports, raising supply concerns in an already tight market. Global inventories are forecast to decline through the fourth quarter. In fact, global inventories are forecast to decline. And that means less supply of oil boosts the price. Fresh sanctions or tightened sanctions on Russia. Again, less supply boosts the price. We'll see if that has much of an impact in markets over the next few weeks. But really, CPI is the talk of the town at the moment. Obviously, the ongoing situation in the Middle East continues to be a factor we need to think about. But kind of headlines off the back of that have gone a little bit quiet as of now. Bring across to the grid, have a look at US equity futures. I say slightly higher there. Four of them are higher, but 0.1, 0.1, 0.07, 0.07. So, they're pretty flat. European equity futures, okay, they're red across the board, but again, the highest percentage they're down to 0.3. They're all 0.18, 0.2. So, relatively flat, not much to see there with European equities. Asia Pacific equities red across the board, playing a bit of catch up from the downside across the US and across Europe in yesterday's trading session. Commodities across the board higher, with oil higher 1.5%, so that is obviously in line with what we have just suggested. Yields lower in today's session so far, which drags the US dollar down lower with it, but again, these are just moves contrary to what we saw yesterday. Sterling higher across the board, but it's pretty flat. FX land, there's not too much to be done in FX land at the moment, albeit US dollar slightly negative, but we had massive moves across the board yesterday. You can see US dollar, you can see massive upside across the board. You can see your Aussie, Kiwi, Euro and Sterling all lower. You can see your dollar Swiss, dollar CAD, dollar yen all aggressively higher post CPI. You can see stocks, you can see your S&P, your Dow Jones, your Nasdaq, and especially your Russell all getting hammered in yesterday's trading session. Massive sell-off into the close on these. The massive downside is 6 o'clock due to some weak demand in the treasury market. They had bond issuance yesterday in the US, and there was a strong lack of demand for treasuries in yesterday's evening, should I say. So the first move here is off the back of CPI, kind of a little bit of a pop back higher, but the aggressive move lower was due to the fact there's a lack of demand for treasuries. A lack of demand for treasuries kind of helps boost the price and push the price higher. As you can see, that was the move off CPI yesterday in the 2-year, but the 10-year, that was the move off CPI, and then another aggressive move at 6 o'clock yesterday. There's a lack of demand for bonds. Obviously, the price of bonds then drop, which then pushed yields higher. So that is another risk factor we maybe need to look at going forward, as if there's a lack of demand for bonds that will push yields higher, essentially drives interest rates higher, and that is not a good situation for stocks, but is positive for the US dollar. So CPI move, in my opinion, overcooked yesterday. I mean, look at your Aussie and your Kiwi, they got hammered yesterday. You look at cable, where to start. 23.14, should I say, and the 21.74. It's a good 150 pips in yesterday's session. That it's a massive move off the back of not that much. I mean, you can see, we come back to yesterday, we can see CPI, consensus 3.6, actual 3.7, in line with previous month. It's not a massive beat. 0.3% consensus, 0.4 actual, which again just 0.1% beats. Core CPI in line with expectations. So it's not like 0.4%, massive beat on inflation, massive problems, inflation's rising again. It's just, I don't know, I was a bit baffled at the size of the move yesterday, to be perfectly honest with you. And then obviously that's kind of compounded by the fact there was a lack of demand for treasuries in a bit of data yesterday, and that then caused yields to pop higher again for reasons that we have just pointed out. Inflation out of China this morning at 2:30. You can see we got trade balance figures, trade surplus widening, which is one positive, but exports down and imports down. It's just that imports were down a little bit more than exports, but see then trade balance above consensus, above previous, so positive in terms of that. Not a positive figure really for in terms of growth, but PPI beat consensus, or missed consensus should I say, minus 2.5%. So terribly weak inflation prints out of the producer price index. In terms of CPI, consensus 0.2, actual 0%. No inflation over the last year in China. Month over month, slight 0.2%, which isn't too bad, but mixing up my words, missing consensus by 0.1%. So lack of price growth, lack of inflation in China, and that is a negative for the Asian economy, which is why Asian stock indexes are aggressively lower across the board to begin today's trade. Inflation out of France bang in line with expectations. Apart from that, got Michigan consumer sentiment. It is the preliminary figure, so we will keep an eye on that at 3 o'clock today. But ultimately, we are through most of the data for this week. As I said, we'll have a look at Michigan consumer sentiment at 3 o'clock later on today. But apart from that, we are pretty much done in terms, I say pretty much, apart from that, we are done in terms of economic data for the week. What does that mean then going forward into today? I mean, do you want to trade the retracement in the US dollar? I wouldn't say it's the worst idea in the world if we didn't get the situation with the bond market yesterday, but ultimately CPI is a little bit overcooked. I think those moves were a bit overcooked, but they were exacerbated by the bond market situation. And stocks looking like they want to pop higher to begin this European session. They got a lot of room to give back if they were to get back anywhere near these highs from yesterday. A bit of a counter move against these trends wouldn't be too surprising. I mean, you can see yields pushing lower to begin the session. 2-year yield through the lows, or certainly making an attempt to break through the lows. So I mean, I don't think it's the worst idea in the world to look for a retracement against these moves, whether it's a bit of profit taking or a bit of a rebalancing of the move from yesterday. I don't think it's too bad of an idea. Oil came back and filled this gap from the other day. I know it's a candlestick here, but that's a gap at the open on Sunday night. Came back to fill it to the pip. Nearly got to it on Thursday morning yesterday, got to it on Thursday afternoon, and has popped higher again. Obviously there's a reason for that to pop higher, kind of strengthening sanctions plus expectations for supply to be tight going forward for the rest of Q4. So maybe some oil longs, stock index longs don't seem like a bad idea as we head into European trade for the day.